Afternoon, everyone, and welcome to our Thrive Financial Wellness Ask the Expert Student Loan Series. Today, we are going to talk about all kinds of things student loans. So grab your pen and notebook and pieces of paper to jot down all of this great, wonderful information that we have in store for you. Thank you so much for joining us. My name is Dominique Velger. I am the Community Engagement Specialist. Along with me is my colleague, AVP Migdalia Gomez. She's AVP of Community Engagement. So she'll be in the background. She might jump in and maybe to talk and join us in this, but she's going to be in the background doing a lot of your questions, fielding your questions. So again, thank you so much for joining us. So before we get started, some household rules. So we're muting your background. So if your dog is barking, no worries, we won't be able to hear them. And also we're going to use the Q&A feature. And actually we can just kind of check it to see if it's working. You can share with us where you're joining us from today, and what city or town or state you're joining us from. Let's see, let me take a little peek here, see where you guys are joining us from. Okay, let me see. Where is everybody joining us from? Anywhere? While people are putting those in the Q&A, I wanted to also remind you that we are recording this presentation, and you can watch it on your time too if you miss any portion of it, or if you would like to maybe share it with some of your friends. It's on our YouTube channel at My HUECU. And you can just, watch it. Anything that we missed or anything that you want to go over, you can watch that. And also at the end, we have a survey for you, so you can tell us how we did and what we can do better. All right. You can go on our YouTube at youtube.com/myhuecu. So before we're going to get started, so what's the difference between a credit union and why we here? So the credit union exists because it's for our Harvard community. It's a not-for-profit banking, and any of our affiliates can also join us. Once you're a member, you're always a member, even if you leave the job. And you can join with your family, your spouse, your parents. They can all kind of join in because you also are a member. We provide a variety of different stuff, things for you as far as loans and checking and savings accounts and CDs. And then you can also access us anywhere from online, in person, and you can also come to any of our branches. So basically are here for you. And without further ado, we have our today's panelist, Mel Martinez. She is our loan servicing and support supervisor. We also have Tanya Tenaro. She is VP of Education and Consumer Lending. So they will be our two panelists today. They will be answering all of your questions that you've put in your sent to us previously. So ladies, welcomes.
Thank you.
All right. So we're going to get started. Our first question is, how do I pay for college? This one is going out to Mel.
Thank you, Dominique. So yeah, this is a great question. There are actually a few different ways that you can pay for college. So the first one being any savings that you have set aside specifically for school. So something like a 529 college savings account, which is a state-sponsored savings plan for education costs, is a popular option for college savings. You also have grants and scholarships as another resource, and that is free money. And so grants and scholarships can be offered by different organizations and companies like Coca-Cola, or even local businesses in your area may offer scholarships that you can apply for. And some scholarships and grants may be offered directly through the schools that you're applying to. And then once you've exhausted your savings or your free money options like grants and scholarships, you can then look into options like federal or private student loans. So if you're a citizen or an eligible non-citizen, you can apply for federal student loans by completing the free application for federal student aid, also known as FAFSA. And in addition to loans, you can also apply for federal grants and work study through the FAFSA application as well. And so for those that may not be familiar with work study, it's basically it's part-time employment on or off campus that can be used to earn money that can, of course, then be used to pay for educational expenses. So again, that would be the FAFSA application that you would use to apply for any federal student loans or federal funding. And that application can be found on the studentaid.gov website, which I'll place in our chat for you shortly. And then as far as private student loans are concerned, you can apply for private student loans through lenders such as banks, credit unions like HUECU, state financing authorities, which is often the same place you'll receive your state grants through, and then other private financial institutions like Earnest or Discover Loans. And then lastly, we also have the option of income share agreements, also known as ISAs. This is a newer option to the student lending world. So it's not as common as your loans or scholarships, but ISAs may be offered by the school or private ISA lenders like Stride or Align. And basically you're agreeing to pay a portion of your future income towards your student loans, which is typically 2 to 10% depending on your individual agreement. And if you don't meet minimum salary requirements under the ISA, you don't have to pay the loan. So again, this option may be a valuable alternative for people who don't qualify for federal student loans, or just an alternative to private student loans as well. So keep in mind, however, that these again are a newer option to the market. And so they're being looked at very carefully. And so you just want to make sure that you do your research to make sure it's the best option for you if you do look into an ISA.
All right. Thank you so much, Mel. We're going to move on to the second question. Are there any student loans that don't require a cosigner? Tanya?
Yeah, so essentially all loans, regardless, if you're planning to apply with a cosigner or not, they're going to look at, specific underwriting criteria just to make sure that, you're able to pay the loan back. And so that criteria includes things such as, employment, credit history, your credit score, income. And essentially, when you need a cosigner is when you're unable to meet any of that criteria on your own. And so, typically undergraduate students that are right out of high school are much more likely to need a cosigner, specifically just because they don't have, that demonstrated credit history and income to support approval on their own. And, oftentimes it can be challenging, for first generation college students who may be from lower income households or don't have support from their family. I worked in financial aid and oftentimes it was harder for them to find cosigners for loans. And so, essentially most loans will look at, most lenders will look at ensuring that you can meet certain criteria. And then if you don't meet that criteria is when ultimately you would need a cosigner for the loan. But regardless, if you can get approved, on your own, sometimes there's still a benefit to having a cosigner associated with your loan simply because they can, help you potentially get, a better rate on your loan as well. And so, sometimes if you don't have a cosigner, but you might need one for loan approval, federal loan options could be, a good choice simply because, lenders have a bit more strict credit criteria that they're looking at when it comes to loan approval. Essentially, loans that you borrow through the federal government, their primary concern is that you don't necessarily have bad credit. You don't need to have well-established credit history sometimes to be approved for federal loans. So sometimes that's a good option. For international students, we do get a lot of questions from international students around cosigners as well. And so, many lenders, simply because there's a higher risk associated with lending to folks who might not necessarily live in the country or have demonstrated credit history in the United States. The underwriting criteria can vary from lender to lender, but most will require that if you're, a non-citizen and borrowing, that you'll have a cosigner that's associated with your loan. But for the most part, lenders are looking at loan approvals somewhat in the same way. And so they're looking at, are you approvable on your own? And then if you're not approvable on your own is ultimately when they would, be looking for a cosigner.
Right, let's move on to the next question. What are the rates for HUECU student loans? Tanya?
Yeah. So as Dominique mentioned when we started, as a not-for-profit financial cooperative, all of our profits get invested back, into better products and services and oftentimes more favorable rates. And so that's something that we're proud of. And especially, as you might be, looking at student loans for the upcoming year and looking at the rising rate environment, it can be a bit of a concern, but we're pretty happy to offer fixed rate options for all of our education loans for this year. So that's something that we're committed to. Our rates vary based upon the loan program that you might be looking at. And so, it could be dependent upon specifically the loan term that you're selecting, or it could be, contingent upon some of those factors we already talked about. So your credit, your income, your debt. And we will look at those factors for both a primary borrower and a cosigner associated with the loan. So generally, our rates right now range from 3.5 to about 7.25. But we also offer a number of different discounts on our interest rates. And so that also varies based upon the program. But we offer, discounts on your interest rate for setting up automatic payments associated with your loan. For some of our programs, we're offering, discounts if you have a cosigner associated with your loan. And then also if you have, an established qualifying relationship with the credit union, where you have other products and services you take advantage of.
All right, let's see the next question. What is PSLF, Public Service Loan Forgiveness? Mel?
Yes, so public service loan forgiveness, also known as PSLF, allows qualifying student loans to be forgiven after 120 qualifying payments, so 10 years of qualifying payments, while working for a qualifying public service employer. So eligible employers include government organizations, 501c3 nonprofits, a not-for-profit that's not 501c3 designated, but meets other requirements related to public service. And then lastly, AmeriCorps or Peace Corps. So those are the categories for eligible employers. So it's important to keep in mind with PSLF that what your specific job is typically doesn't matter, just as long as the organization that you're working for falls into one of those categories that I just mentioned, and you're working full time, at least 30 hours or more in order to be eligible, excuse me. And then another thing to keep in mind with PSLF is that your loan must be a direct loan through the Department of Education in order for it to be eligible. However, if you do have other federal student loans, like an older FFELP loan, you can consolidate those loans into the direct loan program in order to make them eligible for PSLF. And then another thing to keep in mind as well is that to gain forgiveness through PSLF, it's crucial that you meet the program's requirements year after year. And so you'll be required to submit an employment certification form with your education loan servicer directly each year for the 10 years that you're under this program. And then, of course, there are other eligibility factors and details surrounding PSLF. So if you think this is an option that you may be eligible for, or you just want to find more information about the program, I would recommend visiting the studentaid.gov website that we linked you to in the chat.
All right, see our next question. How do I handle needing multiple employers to certify for PSLF? Mel?
Yep. And so, like I just mentioned, in order to track your eligibility under the PSLF, you'll be required to send in that employment certification form to your servicer. So if you're working for multiple eligible employers, you would have to have each of them complete that certification form and submit that to your servicer each year so that they can track it.
All right. Next question. How can I pay off my loans faster? Tanya? We all want to do that.
I know, I was just gonna and so, especially while you're enrolled in school, I would say the biggest thing is, you might not realize it, but while you're enrolled in school, interest is going to accrue every single day. And then when you graduate from school, that interest capitalizes into your principal balance and becomes a part of the principal balance, and then interest accrues on top of that. And so really the best way that you can reduce the overall cost of your loan is to make some form of payment while you're in school. I mean, you can be making interest only payments. You can make just a lump sum payment occasionally if you have some, extra money set aside. Even if it's something small, anything that you can pay towards your interest while you're enrolled in school is going to significantly help you down the road. And then there really is no prepayment penalties associated with student loans. I don't know any lender that, has any sort of prepayment penalties that are associated with your loan. And so making extra payments when you can is really important. And I looked on NerdWallet's website. I love NerdWallet. I don't know if any of you guys are familiar with them, but they have really awesome content and articles and stuff like that related to student loans. And so, for example, if you owe $10,000 with an interest rate of 4.5% and you pay an extra $100 every month, you'd pay off your loan 5 years ahead of schedule. And so you might not necessarily realize it, but just making, any sort of extra payment during your repayment period can make a big difference. Another option you have is to refinance your loans. And so a lot of people, when they get out of school, they want to, shorten their loan term. They want to reduce their interest rate. All of those things will help you pay off your loan faster. And so if you're employed and you have good credit, definitely consider refinancing and look at refinance options out there. But also take into consideration, again, the rate environment is changing. And so interest rates are increasing a bit. And so just take that into consideration when you're looking at rate options, variable rate versus fixed interest rate loans. Take advantage of all of your discounts. And so a lot of times people are super nervous to get enrolled in auto payment. But most lenders offer a 0.25% interest rate reduction for enrolling in automatic payments. And so don't let those discounts pass you by if you can take advantage of them. That will significantly help you pay off your loans faster. And then another thing is just sticking to the 10-year repayment plan if you can. You may already have, another term associated with your loan, and that's okay, but the standard term is 10 years. A lot of times people will, take advantage of forbearance and deferment options when they might not necessarily fully need them, just because they want to have some extra cash in their pocket. And for most lenders, when you're in a deferment or forbearance, your loan term gets extended, and also you're going through a period of time where you're not making payments. Definitely be really careful about only using those benefits when you actually need them. And then if you come into any sort of extra money, just put it to good use and put it towards your loans. I mean, it's no fun to get extra cash. Everyone would rather go on a vacation or buy something that they can enjoy, but definitely trying to pay off your loans with any extra money you have is, something I'd recommend. And then another thing is just looking at companies who offer student loan repayment benefits of some kind. It's I don't want to say it's very common, but it's becoming more common for companies to offer student loan benefits, just because it's something I think that younger, employees or people right out of school are looking for. And so, I worked for a company that they offered, you could choose between student loan reimbursement or tuition reimbursement. And so that was really a significant help to me in paying off my loans. So when you're looking at changing jobs, just take a close look at the benefits packages, because, I think a lot of companies are going to be offering help basically to new employees and just employees in general around paying off loans.
All right, thank you, Tanya. Tanya, I really appreciate the tips. All right, next one. How can I lower my monthly student loan payment? Mel.
Yeah, something else everybody wants to do, right? With federal student loans, if you have federal student loans, they offer a number of repayment plans that you can apply for and possibly be eligible for in order to help reduce your monthly payments. And so some of the most popular options for federal student loans are the income-driven repayment plans, because they allow you to reduce your payments as low as $0 based on your income and your family size. And so in these plans, the income-driven repayment plans also have loan forgiveness built into them after 20 plus years of being under that repayment plan. So that's a pretty popular option for federal student loans. Another popular option for federal student loans is the graduated repayment plan. That plan allows you to make interest-only payments for the first 2 to 4 years that you're on it. And then the payments would gradually increase every 2 years afterwards so that you're paying both the interest and the principal balance. And you stay within the term, that 10-year term of your loan. So you're still paying it off in 10 years because they're increasing those payments gradually over the 10 years. And so, again, there's a lot of other options for federal student loans when it comes to repayment options. And so you can go to the same studentaid.gov website, and you can learn more about the options that are available for federal student loans. They have calculators on that website that allow you to see an estimate of what your payments can be lowered to pre-qualify yourself for some of these income-driven repayment plans, and then also to just provide you with direction on the best repayment plan for you in your situation. So definitely recommend checking those out. In regards to private student loans, they don't have as many options as federal student loans when it comes to lowering your monthly payment, but it is still possible to have your monthly payments lowered. So most private lenders offer what's called forbearance or deferment options. And those options can be used to temporarily postpone or reduce your monthly payment within the terms that the lender has outlined, basically. And some private lenders will also give you the option to modify your loan term or your interest rate, since extending your loan term or having a lower interest rate can be a way to lower your monthly payments as well. Keep in mind, though, however, with loan modifications, that they are typically reserved for extreme financial hardship situations. And so the eligibility requirements are determined by the lender. So overall, with private student loans, the repayment options are going to vary from lender to lender. So it's always best to reach out to your lender directly to see what options they have available for you.
All right. Thank you, Mel. What advice do you have for first-generation graduates still in debt over 10 years after graduating? Mel?
I believe that one is for Tanya.
Yeah.
Anya, sorry.
This is a tough question. And honestly, I say it from the perspective of I've worked in admissions, I worked in financial aid, and I also was a first-generation college student myself. And so, the advice that I would give is very similar. Once you're in repayment, basically, whether you're first generation or, just a borrower would be the same. But, the challenge is loans can add up fast. And, loans aren't necessarily the issue. The cost of college, in my opinion, is the issue. And so, I guess what I would say is the smartest thing that a first generation college student can do is really make a good financial choice about which college they decide to attend, especially because oftentimes they don't have a lot of family support. And sometimes even making that choice can be difficult simply because you don't have, your parents or other family support. You might not be getting, advice around how to manage your finances. Or understand, what your student financial aid award letter looks like, or fully understand, all the terms and conditions when you receive your bill from the school. But ultimately really taking, a close look at the type of financial aid you're getting, the overall sticker price of the college that you're planning to attend, and considering also, which college you want to go to and how much that college costs based upon how much you think you're going to make when you graduate, depending upon which program of study you're graduating from. Because your ability to repay your loan, will ultimately depend upon, also, what career field you're planning to move into and how much you'll have to actually support the repayment of your loan when you leave. And so there's a lot more that you can do upfront in terms of, borrowing only what you need and attending a college that you can afford to some degree. But once you're in repayment, the advice is really the same. Some of the things that we already talked about together, which is only taking advantage of deferment and forbearance options if you really need them. You don't want to get into a position where you're extending your loan term or increasing the cost of your loan. And so sometimes during those periods, the same, way as when you're in school, interest continues to accrue, daily, simple interest, and then can capitalize at the end of those deferment and forbearance periods. And so really using those benefits only when you need them. making extra payments, taking a look at refinancing your loans, if you want to reduce your interest rate or change your loan terms, take advantage of any sort of interest rate discounts that you have. And again, really look for employers that offer these new types of student loan repayment benefits. Again, I worked for a company that offered $2,400 a year in student loan repayment benefits. And so it was considered a reimbursement. And so you had to pay $2,400 and then they would reimburse you for that $2,400. And what I did was ultimately pay my $2,400, get reimbursed, and then also put my reimbursement towards it. And so I was essentially able to pay off, over $40,000 in student loans, within the 10 years that I worked at that company, which was a huge benefit. And so, again, I would say really, if you're a first generation college student and you're just starting to look at colleges, I would never want to discourage you from attending the college of your dreams or pursuing a program that you're really excited about, but just take a close look at the cost and make sure it's something that you feel like you're going to be able to afford. During the process of getting your loan, obtaining your loan, applying for your loan, you'll have a number of disclosures that are provided to you, which will tell you specifically what your estimated monthly payment amount will look like. And so it's important to look at that each year that you're applying for loans, because you'll get a sense of specifically, how much you'll need to repay once you graduate and what your monthly payment will look like, which is really important to do up front so that you don't go into shock when you get your first bill. Because sometimes that can be really eye-opening for a lot of people, but that information is all provided to you during the origination process. So just make sure that you're taking a close look and making the best financial choice.
Thank you. What options do parents have to combine their children's student loans to pay them off faster?
Yes.
No?
Yep. So if you borrowed a federal Parent Plus loan and want to combine them with other federal student loans that you have in your name, you can apply to consolidate your loans through the Department of Education. Keep in mind that consolidating your federal student loans through the Department of Education is the only option you will have to combine them and keep them in the federal loan program. So you can't consolidate private student loans through the Department of Education. It can only be federal student loans. However, you can refinance both federal and private student loans into one loan in order to combine them. But also keep in mind, if you do refinance your federal student loans, that once you refinance them, they're no longer federal. So that means you lose any benefits that come with federal student loans, like the repayment options that I spoke about earlier, like income-driven repayment plans and so on. You would lose those options once you refinance them with a private lender. So that's something to keep in mind if you are looking to refinance any of your federal student loans. And then also keep in mind as well that the loans typically have to be in your name in order for you to combine them together. So it can't be a loan that's in your child's name that you're consolidating or refinancing under your name. It has to be your name in order for you to refinance them or consolidate them together.
All right. What's the best way to consolidate loans and remove a cosigner from the original loan? Tanya?
So, we talked a little bit about, the underwriting criteria that lenders look at when you go to refinance your loans. And so when you apply for any refinance loan, essentially they're going to be reviewing those factors: income, debt, your payment history, credit, all of that stuff. The good news is that if you're approvable on your own, essentially when you're applying for a refinance loan, the lender that you're applying with is actually going to pay off your loans that you want to refinance for you, right? And so if you've applied and you have been approved on your own and the underlying loans have been paid off, essentially you and your cosigner are no longer responsible for, the loans that you refinanced. Any loans that have been paid off, it will show as paid off on your credit report. And so your cosigners will no longer be liable for those. And so just, by going through the refinance process, essentially your cosigners are removed from the loan. But for the most part, you'll need to be approvable on your own in order for that to happen through, whatever lender you're applying for the refinance with. It's important to remember, though, I guess, I made a note here about, even if you're approved on your own to refinance your loans, sometimes applying with a cosigner can have benefits. And so we talked a little bit earlier about just, a cosigner, especially if you're right out of school, even if you're approvable on your own, they might have a more established, credit history, a higher level of income, a better credit score. And so those things can, improve your chances of getting a better rate on your loan. And so that's something to consider as well, when you're talking about whether or not you want to have a cosigner associated with your loan and whether you want to remove a cosigner from your loan. So I would just, take those things into consideration.
All right, let's see what's next. What student loans are available for graduates slash doctorate programs? Mel?
Yes. So there are essentially two options for graduate student loans. So you'll have your federal and your private options. With federal, you can apply for a federal direct loan for a direct graduate plus loan through the Department of Education by filling out the FAFSA application that I spoke about earlier. And so you would just basically submit that application, and it's based on your credit and all of that information as well. With private student loans, again, those are offered by banks and credit unions, and you would apply directly through the lender in order to be awarded a private loan. Keep in mind that when you're borrowing a loan on your own, as Tanya mentioned, there will be considerations for your ability to repay the loan. So that includes your income, debt, and credit as well. And that criteria can be stricter with private student loans versus federal student loans. It's also important to remember that to borrow only what you need. You don't want to borrow more than what it is that you need. For many graduate students, they end up finding themselves in a significant amount of debt, since often they're also borrowing to cover their living expenses. So just, make sure you're borrowing at what you actually need, because again, it has to be paid back at the end of the day.
Okay, let's see if we have some live questions in the Q&A feature. Let's see what everybody has. Hold on one second. You guys can put your questions in here.
Hi, Dominique and Tanya and Mel. One question that we did get was any final tips for those that are borrowing or that are in repayment?
For those that are in repayment?
Yes, any final tips?
I think Tanya mentioned a lot of really good tips. If you are in repayment and you're in a position where you're able to make extra payments towards your loans, that's definitely something I would recommend, just because it is going to help you to pay off that loan balance sooner, and it's also going to save money on the overall interest accrual throughout the life of your loan. So that's something that I always recommend to our members if they're in a position to do so with their student loans. And then, like she also mentioned, taking advantage of any discounts, the recurring payment discounts. We offer like relationship discounts for our student loans. So just looking into any discounts that your lender may offer so that you can continue to save money on that interest accrual.
I would just say know your loan. It seems so simple, but we have, during the origination process, like I mentioned earlier, it's like you get all types of information required to provide it to you that tells you what the overall cost of your loan is going to be, what your monthly payment will look like. Oftentimes people are in this mode of like set it and forget it, but know how much your loan is for, know how many loans you have, understand what benefits are available to you through the lenders that you have, interest rate discounts, be fully aware if you take advantage of forbearance and deferment, what that means in terms of continued interest accrual and capitalization. I think, you know, a lot of times it's really easy to just be like, oh, I can't make payments, I'm just going to apply for forbearance. And then you get out of forbearance and you're like, wow, my loan has increased so much. And that's because you haven't been making payments and interest has continued to accrue. And I would never want to discourage anyone from taking advantage of benefits when they need them, but really use them only when you need them, I would say. And, you know, right now it's like everyone's getting this benefit of not making payments on their federal student loans. But if you make payments, it is, please make payments. If you can make payments, because ultimately what that means is those payments are fully going towards your principal balance. And so when you enter repayment again, you know, essentially interest is going to be accruing on a smaller balance, right? That's what you want. You want interest accruing on a smaller amount. Interest is really where people, I think, you know, sometimes people don't necessarily understand how interest works. And so if you can make payments, even if you're not required to make payments, it is such a good idea. Because I don't have a crystal ball. All student loans are not going to get forgiven. If I did have a crystal ball and I felt like I had any sort of ability to look into the future, I would say, you know, if there's any sort of loan forgiveness that might come up outside of some of the things that Mel already talked about with public service loan forgiveness, it will be for a minimal amount of, say, maybe $10,000, and it will be based upon income, you know. There will be some sort of income requirement, but even if a certain portion of debt, say $10,000 gets forgiven for some people and it's not contingent on income, most people have significantly more debt than that. So I would say, you know, while you're taking advantage of this 0% interest on federal loans, make payments while you can. And then, you know, I know probably Medallion, Dominique, you know, if you attend their sessions and, you know, you probably know a lot about the services that we offer, but don't forget to check out, you know, Thrive Financial Wellness. I mean, Dominique and Medallion do a great job, and we offer a lot of resources around financial education. And, you know, our partner Green Path Financial Wellness, Mel and I refer a lot of our members to them specifically who might have difficulty repaying their loans. They offer free student loan counseling for federal loans, debt management plans. They'll do credit reviews with you. You know, there's just a lot of services that they offer at completely no cost that can help get you in, you know, a better financial position to refinance your loans or to repay your loans if those are things that you know, are having trouble with or looking to do in the future. So.
And one other tip I'll add as well is just don't be afraid to reach out to your servicer or the lender. You know, oftentimes student loans can be very intimidating, especially when we get behind on them. You know, so it can be scary to have those conversations. But oftentimes there are options available for you to help you avoid, you know, falling behind on payments or defaulting or any of those things that can land you in a jam. So don't be afraid to reach out to your servicer or your lender to discuss your options in general, because it really can save you down the line.
Mm-hmm. And if we're your lender, call us.
Yeah.
Please call us. To Mel's point, it's like, you know, a lot of times people fall into trouble and they just don't, they're nervous, so they don't want to call their lender, but then you mess up your credit. And your credit is the most important thing you have to make sure that you're going to be able to protect your financial future. And so taking advantage of benefits that you have is much better than falling behind in your payments. Don't fall behind on your payments. There are so many protections in place. Federal loans have a lot more protections than private student loans, but both have options in terms of temporarily postponing or suspending payments if you need to do that. Do not fall behind. Know what your options are, you know, and reach out if you need help, like Mel said.
Right. Thank you so much, ladies, Mel and Tanya, for your great advice and great tips. I hope everybody was jotting everything down to help you with your financial goals to help pay off those student loans. They can be quite a pain. At the end, remember, I told you at the beginning, I'm reminding you again, we have a survey. Go to huecu.org/survey. Let us know what we're doing to help you, if we can do it better. So just, again, go to huecu.org/survey. And we talked about Tanya, as well as Mel talked about Thrive Financial Wellness. You can visit them on huecu.org/thrive. They have a bunch of different blogs and workshops and different worksheets you can actually work on while you're online, in short videos, calculators, a bunch of different things to just kind of see how we can help you with your financial goals. Just wanted to remind you, this presentation is, really for educational purposes. We just provide you with tips. We're not meant here to be construed as tax or legal or investment advice. We just wanted to give you some teaching tools to kind of help you get on the right path, in this particular case, to help you pay off student loans and help you manage them better. And keep in touch with us at huecu@harvard.edu. Again, this particular webinar is recorded, and you can watch it again on our YouTube channel at My HUECU. And you can also follow us on social media, Instagram, Twitter, Facebook, and also on LinkedIn. And we're so happy that you guys joined us here today. And again, a big thank you to Tanya and Mal for giving us their great tips and great advice. Hopefully that will help you, and we're going to keep our fingers crossed that we will get some relief from some of these student loans. Thank you so much for joining us today. Have a great afternoon.